Hello and welcome to Wealth and Wisdom TV. Today we're going to talk about market cycles. As we know, the markets continue to move. Cycles rotate, but eventually they stop. Where are we today and what is the next cycle coming? Stay tuned, lots to talk about. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click Show More for additional information and links on today's video. We have a lot down there for you. Also, if you're looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing. Talking about subscribers, big month last month, 500 new subs. Thank you so much for joining our conversation. The other thing is we've had a lot of questions about who we are and what we do. Have a link up here that talks about Michael and also services we offer if you don't meet our minimum, because we still work with a lot of different folks. Next up, our agenda. Today we're going to go through the big charts, of course, bring in some treasuries, talk about our signals right now. Where are we on that cycle? What keeps me up at night? Sectors, where are we with this cycle? Last but not least, we're going to go through fear and greed, wrapping things up. But let me tell you something, folks. This is no fun and games. Let's get started. Okay, first up, S&P Daily. But what did I say just 2 weeks ago? And now I'm not surprised that although we are positive, I have a negative view that we're going to end back in the box here before you know it. As you can see, I did not particularly like this market. Where are we today? A couple different things. One, this line here is resistance, okay? And that's basically our high 1 year ago, which is exactly where we are today. So not a lot of movement. From there, I look down here, that's momentum. We've had a negative crossover, not good in the short term. And then volatility above 15 keeps us cautious as well. But let's take a closer look here and discuss my signals. So right now I'm recording this. It's Monday about 12. Couple things. We are up today. Why? How? Oh, guess why? Steve Mnuchin last night made a comment about getting closer to a deal with China. Please, don't get me started. Now, that being said, right now, I am neutral. Why? You know, as I mentioned, I thought we were going to go down. We topped off. That's what we've done. We've hit right here once in this area of support, but came back up. Not a bad sign. But at this point, I don't see us in a negative view until we come back into this box. So again, short-term signal, neutral with a negative bias. Here's our weekly chart, midterm. What has changed here, if anything? Well, for one, we are definitively below the trend line. This is our trend line right there. So when I look at that, we're below in the trend line. Momentum here on a weekly chart, still struggling to get above. So we continue a negative bias on the short term. Next up, our monthly view. What, if anything, has changed here? First off, nothing. We are still negative. Why? Look, right here, that is back in 2007. You had a negative crossover on momentum, okay? Negative crossover in 2015. And here's our negative crossover from last fall. Has anything changed? Not at this point. You can see it there. It's fighting, but it is not getting above there. I've talked about this. This line right there, you've got negative divergence in what's called relative strength. Not good. That goes down as we hit new highs. So again, we are negative, so we're neutral with a negative bias. Negative, negative. How about some background information? Here's a chart I haven't shown in a while. New highs minus new lows for NYSE, so the entire market. This is a good chart, right? Last year, okay, when we hit our highs, you can see the strength, right? These are new highs going up in a series of higher highs. And last summer, I had talked about this. I did not believe the run-up because of the new highs minus new lows. In fact, we then had a pullback. And you can see it, right? We're hitting new highs versus new lows, etc. So, and it's weak, weak, weak. But the other thing I see here, 1, 2, 3. That's a classic head and shoulders setting up on the market. So again, another reason to be a little conservative right now. How about bonds? What, if anything, has changed? We have come down from our highs. Okay, here's your 2-year through your 30-year. You know, we have come down, not exactly the way I'd want to, but the big thing, of course, is yield spread. So the first one is your 10-year minus your 2-year. 10-year Treasury minus 2-year Treasury is your yield spread for new viewers. If that goes negative, that is not a good thing, right? We're at 0.06%. That is a recession indicator. Your 10 minus 3 month, we've been under it now for several months. That is not a good sign. So I continue to worry about that. I still am of the opinion that bonds go lower down to the 140-50 range. Next up, what keeps me up at night? All right, what keeps me up at night lately? Not a lot, actually. But the market during the day keeps me on the edge. I've talked about this. If you're new, we peaked in earnings last year. Okay, you can see it. If you look down here, because some of the research we do, sales growth per sector, earnings per shares growth per sector as well. Now, from there, this is the most important part. Earnings growth. Is your portfolio ready for a continued slowdown? We went from 24 to 12 to 1.2% growth, 1.6 projections last week I saw, 3.8%. Another major retailer declared bankruptcy this morning. Not a good thing. Let's talk about the federal debt. This is a big story right now. What do you mean? I haven't heard anything about it. We're going to talk about it. Federal debt, right? What's happened? Obviously, we didn't have much, okay? And then we had the crisis, okay? And this is QE, quantitative easing that you hear about, all right? We stopped, and then they started letting all the bonds sell off, okay? That's pretty much a good thing. Now, what was the impact of this? Great chart here from Lance Roberts. Have a link to him below in this article. But our stocks indicating a strong economy. So here's our growth in stocks, 164%. Strong. How about GDP? 24%. Hello. Talk about a diversion there. That is not a good thing. And then you have, again, here's your S&P growth at 164. The Fed balance sheet, 197. That is a big issue. Why? Well, you look again, here's a closer look on our federal debt. Wait, what happened here? I thought this stopped. We haven't seen QE in how long? How come this went up big time in the last 2 weeks? That's what we're going to talk about. Next up, are you aware? Fed's first in a decade intervention. What do you mean? Why is the Federal Reserve pouring money into the financial system? Repo market chaos signals Fed may be losing control of the rates and the repo meltdown. So here's what happened, okay? Overnight lending, cash, liquidity. The market loves liquidity, right? They want to see it flowing naturally, okay? They go in for the night, you're buying securities, you're selling securities, and you're bringing out some cash, whatever the case might be. So we have two things going on. One, the Fed balance sheet, we were selling off, so there was pulling liquidity out. Two, you have earnings going down. So there is lack of liquidity on the corporate side. So what happened was right here, and you can see it, in overnight lending, okay, shot up big time in one day. Okay, so what does that mean to you as an investor? And what does this all mean? I have several links below to an article, okay? Well, what the Fed has had to do is first they put in 50 billion, then 75. They're now doing 75 to 100 billion a day through October 10th. That is essentially QE. And yet, you see where the market is. That's an issue. Continue to watch this. Again, the market craves liquidity. If liquidity dries up, we're going to have some big issues. How about consumer sentiment? We see what's going on here. Hello, big drop in consumer sentiment. Not a good sign. Some of the background data, industrial production. We have a 31-month low rate there. You know, I'm not that bearish. I want this market to be good, but I work on the data, and that's exactly what you want me to do. Real GDP, what happens here? Once again, we're going down, okay? Hopefully you like some of these new charts we created with our Wealth and Wisdom logo. Spend a little time here, continue to do research, but haven't talked about this before. This is a real good indicator if we do, in fact, head into tough times. Why? Yellow line is your high yield, okay? Delinquency rate, obviously delinquency rate from these high yield companies. The high yield market funds small companies, mid-sized companies, mid-cap sized companies, etc. So as you see, when the market goes bad, you see a spike in both of those. Now, right now, have a little bump, not big, not trying to concern anybody, but I will continue to watch this to see where this goes. Next up, what's on my radar? Game plan going forward. All right, what's on my radar? Continue to be those sectors that do well, okay, at the end of the cycle. We talk about the cycle. Okay, where we are right now, bonds, bond proxies continue to do well. Here is one of those sectors. This is home construction. Okay, today it's up 1.6% alone. Okay, and we're up 20% year to date. This has really been a great sector for us. Been in since last November. Definitely like it. Now, what does it mean to you, an investor, and how do you look at this? Well, let me add a couple things. Okay. If you're coming in and looking at this sector right now, I'd say be patient. Number one, it's a little expensive. RSI, relative strength. When you get above 70, you generally will see a pullback, maybe a flattening out. So I would be careful. So why is this sector doing so well? Well, there's your 10-year treasury, right, going straight down. And how about this? Lumber, right? Think about it. How do these things tie together? They all do. So you've got Treasury rates going down, borrowing power is cheap, the price of lumber has basically been cut in half, okay? So we have more profits for the builders. That is a good thing. Now, next up, we're going to talk about oil, but what did I say a couple weeks ago, okay? But be careful, folks. You're still in a downtrend here, all right? I am personally going to stay away from oil. When you have this type of geopolitical risk, you gotta be careful. So this is a big deal. All right, so obviously a couple weeks ago I told you not to get into oil. Do not buy the headlines, okay? Buy the data. It spiked, there it is right there. And then what has happened since then? Exactly what I expected, because the data doesn't support it. We are back below, not really a good place to be. Let's continue on. Let's talk about this sector and how these bond proxies have done during this part of the cycle. Okay, when we talk about this and the sector focus and game plan, as I've mentioned, we've been in bonds and bond proxies since last November. But what do you compare it to? Everyone thinks of asset allocation, right? Large cap growth, mid cap, small cap value, international, emerging markets. That's kind of your typical advisor when they talk about those type of investments in asset allocation. This is showing you year over year. Where are we? This is your NASDAQ. There's your S&P, okay? Mid-cap down, mid-cap value up. Smalls really down, okay? Emerging markets. And then we have international. But let's take a look at some of these bond proxies. Wait, did I turn that chart upside down? No, I did not. This is year over year. So today, back a year, this is an asset allocation model. These are the places that we have been in the last year. You can see the difference in performance. All right, wrapping this guy up here. This week, 52, neutral. Overall, how you get this information below. 2 weeks ago, we're a little bit greedy at 75. Neutral on the short term with a negative bias. Midterm, long term, negative. Be careful out there, folks. Thanks so much for watching. Michael Loftus for Wealth and Wisdom TV. I think I might have to sit down.